Joining us now is Neuberger Berman Private Wealth Managing Director Holly Newman Kroft. She oversees more than $3.5 billion in assets under management, recently inducted into the Barron's Hall of Fame of top financial advisors. Quite an introduction. Holly, welcome. It's always good to have you.
Great to be here. Thank you.
So since we last talked, there has been a lot of volatility swings. How have your clients navigated it?
Yeah, it's been 4 or 5 weeks since I last saw you. The market's gone down, the market's come back up, and we're probably in the same place today that we were a month ago, but we've been able to take advantage of all those market movements for our clients. So when the market's down like it was in October, we can take clients who have underweight equity exposure and maybe add some money to equities to get those clients to a neutral weight. In November, when we've seen a nice rally, we'll capture some gains for clients that are overweight equities and reduce their exposure to neutral. We're looking for clients to have a pretty neutral equity allocation as we end the year. And luckily, we do custom direct investing at Neuberger Berman. So we're tax loss harvesting all year. It's no longer just a year-end phenomenon. So even if we're taking gains, we've been able to harvest losses all year, because when you look at the equal weighted return of the market, 6 months of the year, it's been negative. The growth is really fueled by such a small handful of stocks. So we've been able to capture some losses to offset any gains we might be taking now.
It's consistent with your view in the last few months or the last year or so. It's been pretty cautious on the equity market. You like private credit better, alternative investments, private equity. Why better in the private market now than the public market?
Yeah, well, private credit specifically, companies can't access debt. Banks are much tougher. The interest rate environment has changed the whole lending market. So there's nowhere else to go. So if you have money, you can charge a higher return for that money. So we really like private credit. It's offering our clients strong double-digit returns with less risk than private equity. And that's the only place that companies can go to access that type of capital. So if you have capital and capital is otherwise scarce, you're going to dictate the terms of that capital.
What do you think when, the head of UBS says the next crisis will be in private lending and private credit? Is it just a natural pushback from a legacy industry?
Don't you think that whenever something is hot, there's always going to be a contrarian view? It keeps the headlines going and it keeps the market strong. I think in the private markets, much more so in public markets, being with a top-tier firm and a top-tier manager in terms of returns and risk is crucial, because the delta from a top-ranked private equity manager to even a middle-ranked manager can be 10%. So we're really lucky at Neuberger Berman, when 90+% of our funds are in top decile or top quartile rankings, that we have access to such high-quality funds for our clients.
Do you guys have a view on where rates go from here? It seems like that's the linchpin for all of these asset classes, is whether we've seen the top in yields. And as we were just discussing with Steve, not fully clear whether the Fed is done.
Yeah, it's not clear. We are certainly near, if not at, the top of the rate hike cycle. And wherever rates are today, tomorrow, next week, that's not really how we think about investing for our clients. We invest with a long-term view. And our view at Neuberger Private Wealth is that a year from now, rates are going to be lower than they are today. So we can capture such healthy returns. We are extending our duration in our portfolios to lock in these rates for our clients. We are switching our exposure from floating rate to fixed rate high yield, again, to lock in that exposure, because we're being paid to sit on the sidelines and wait. The fixed income market is offering us equity-like returns, with much less risk. And there's so much uncertainty in the world today that's going to drive volatility. And arguably 2024 is going to be just as volatile as we start to enter a presidential election.